Long before stock markets or central banks existed, traders were already tracking a simple relationship between two metals: how many ounces of silver it takes to buy 1 ounce of gold. That relationship is called the gold-silver ratio, and precious metals traders still watch it closely today. The math is straightforward. Take the current price of gold per ounce and divide it by the current price of silver per ounce. If gold trades at a given price and silver trades at a fraction of that, the ratio tells you how many ounces of silver currently equal the value of 1 ounce of gold. This isn't a modern invention. Governments in ancient Rome and later bimetallic monetary systems in the 18th and 19th centuries actually fixed this ratio by law, pegging the value of gold and silver coinage to each other at a set exchange rate. Once free-floating metal markets took over, the ratio stopped being fixed, but traders kept tracking it, because it kept moving in patterns worth watching. Here's why the ratio moves at all. Gold and silver don't behave identically. Gold trades almost purely as a monetary and store of value asset. Silver has that same store of value role, but it also has heavy industrial demand: electronics, solar panels, medical equipment, which makes silver's price more volatile and more sensitive to economic growth expectations. Traders who follow this ratio tend to watch for historical extremes. When the ratio climbs unusually high, it means silver is historically cheap relative to gold. When it falls unusually low, it means silver is historically expensive relative to gold. Some traders use these extremes as a cue to rotate between the two metals, on the idea that extreme readings tend to eventually move back toward more typical historical ranges, a strategy generally known as mean reversion. It's worth being careful with this idea. Mean reversion strategies assume history repeats in a predictable way, and the ratio has occasionally stayed at extreme levels for extended periods rather than snapping back quickly. It's a historical pattern to be aware of, not a guaranteed trading signal, and it works best combined with other analysis rather than used alone. Here's why this matters even if you're not actively trading metals. The ratio is a quick way to understand relative value between two commodities that often get lumped together as precious metals but actually behave quite differently: gold as the more purely monetary asset, silver influenced by both monetary demand and industrial demand. 3 things to take from this. The gold-silver ratio is simply gold's price divided by silver's price, tracked by traders for centuries. Extreme readings, historically high or low, are sometimes used as cues for rotating between the two metals, based on a mean reversion assumption. And silver's added industrial demand is exactly why it tends to be more volatile than gold, which is worth understanding before comparing the two as if they were interchangeable. Gold gets most of the attention in financial headlines. But the ratio between gold and silver has quietly guided traders since long before either metal ever needed a headline to matter. We track the financial traps that don't make headlines so you're never caught off guard. If this helped, subscribe. We post every day. I'll see you in the next one.